Hey everyone, this is Addy again. So today we will discuss three beginner-friendly trading strategies that I have come across and I've traded in the past and have been successful at. Some of my audience have come to me with questions around they've been buying options in the market and they've not been really successful. So this is my way of showing there is another way in the market where you can sell options and then create a consistent profit machine with risk management and with all the kind of stuff that I've done in the past, and I teach this to my other students in my programs. But um, this is my view or my take on top three beginner-friendly trading strategies to kickstart your options journey. If you haven't really started yet, or even if you've started, this is another way of increasing your monthly profits or your monthly income. Let's dive into it right away. What I'm showing here is a document that I've prepared for just to give you an overall idea of what these strategies are, and then we'll go into the platform to actually look at setting up these trades and how to trade these strategies. So this is some theory. Then we'll go and do some practical stuff, some real stuff on putting these strategies on. So first one is cash secured put. Now here's the big take on this. You got to select underlying tickers that you would really like to own. And you have the cash secured in your account to buy those assets. So, what I mean by that is, let's say if you like the stock right now and you don't want to pay the current price, what you can do is sell a put on it and then try and get assigned so that you are buying the asset at your price, not what the market is giving you right now. For example, what we are going to look at here is I've already got some Apple stock here in this is my paper trading account. So, and I already have some positions because I did some other videos. Anyway, if I were to trade an asset right now, and let's say if I were to trade a Apple stock, right? This is something I would like to own. I don't have enough of it in my portfolio. So I would like to own 100 shares of this stock. And this is how I would own it. This is my first strategy, cash secured put. This is how I would construct it, build it, trade it, execute it, and then risk manage it. So what would I do? I normally go into monthly cycles, so not these yellow ones. These are all weekly. I don't. You can see the volume and open interest in this. So look at these columns here. You see the numbers in hundreds on the volume side and maybe some thousands here and there. But if you go into the monthly cycle, which is 30 days out from now, you will see thousands of open interest and thousands of volume. You see, this is how the underlying. This is how this expiration traded today with that many open interest. So, which means that you will get better liquidity in the monthly cycles, and therefore we have to stick to monthlies. Now, secondly, what will I do now? So it's trading at $229. Let's call it 230. I don't want to pay 230 for this stock. I like it at, let's say, maybe 210. But then you got to check your implied volatility on this. So go on the charts and then see how the implied volatility has done, or what is it doing right now. It's basically at the bottom, which is fine. I mean, the best time we would have sold the put at would have been this time here when the implied volatility was up in April. Tariff news broke out, markets dropped. This is where we would have sold it. But if that time is now gone and you still like the stock, now this is right at the bottom, right at its average. So it doesn't go beyond this line or beyond this number. It's currently trading at 28% implied volatility, which is fine. The other thing I would look at how the price chart is done. So I have some indicators here, which is just the moving average of last 32 days. Now, why have I chosen 32 days? That's because I normally trade 45 to 50 days, 35 to 50 day cycles, and during which period I get 32 to 33 trading days. And therefore, that's why I've chosen this kind of indicator with these kind of settings. Anyway, this is telling me that the stock is really bullish because the price has gone beyond its 32-day moving average. That's all it is. So it's going up. It still hasn't touched its all-time highs, which is $200. And then if I like this, and then see how it goes. So I'm going to select anywhere between 20 to 17 delta. Right now, I would select the $215 strike, which is $15 below the market. So I'm getting some discount here. And I'm going to sell a single. Okay. Now, my setting gives me 10 contracts at a time, but I don't want that. I want to show you the margin and everything else that comes with it. So, and I would increase this price to 225. So I'm collecting $225 on the option. Now my break even will be 215 minus this number. So I'm selling at 215 and I'm collecting 225 more. So deduct 225 from 215, and that's where your break even will be. And I can show you that on the chart. So let's go on the analyze tab. So what have I got here? Okay, I need to take this stop line out. Now you need to change your break even date. So I'm selling in 920. So I'm going to go in and I'm going to change 920 here. Now what this is showing me is like you've got a 80% chance to like win in this strategy, meaning 80% chance that the price will not come down to this level. Okay, that's what it's showing, and that's what we want actually. Oh, for some reason it just closed out on me. The broker platform closed out. That's okay. Let's bring it up again. So let's go through some theory here. So yeah, let's say now these are hypothetical prices. If Apple was trading at 120, I would have sold it at 170. Right now we're selling $15 down below the market. The numbers here are showing $10 below the market, which is totally fine, which is how some people prefer it. I have done that in the past as well. But my go-to strategy is coming up. Collect $2. We are collecting $225. So slightly more than this. If the stock would have stayed above 170, we would keep the cash. And if it drops, we will buy it at 170. 170 minus the credit that we collected. So that's our new cost basis. We will buy it at 170, but then we collected $2 extra. So our break even or our cost basis would have been 168. That's what I'm trying to show. Now, like I said, I don't trade in during earning weeks. Earnings are not good because of the high volatility events, very one-sided. And then I would only trade one contract at a time. And then if the market drops, then I will scale in, but I will start with one. And I will only do as many as I can control and manage from my cash position. So however cash I have, I would use a certain percentage of it to do this kind of strategy, and then not use up all of it, because you need some money to, like, what do you call it, manage the trade, meaning you have to adjust it, you roll it, all of that comes with a cost. So you have to keep some money in the account so you don't run out of cash. Okay, let's see where the broker platform is. Okay, let's go. Maybe I hit the X button somehow. Okay, apologies for that. It's while it comes up. What else is in the cash secure put? So there are a couple of ways to manage it as well. But if you're not looking to manage, you're just looking to either keep the cash or keep the premium, or either get assigned. Then you don't really need to do anything. If the market stays up on you, above your strike, you keep the premium. If it goes beyond it, then you take the delivery of the stock. And the taking delivery was actually the goal. So that's how we will treat this initial trade, that we are going to take some delivery of this stock. Okay, so we were trading Apple and we sold a 215 strike put option, which is at 20 delta. I like that trade. You can go a little bit below that at 210 at 17 at 14 delta, but then you will not collect enough credit. I can show you that number as well. And we change this price to 225, which is the mid price here. You can also see the mid price. You're more likely to get filled on mid price than your ask price. Analyze the trade. Let's go back, take this line off, prices, and then select your break even, 920. Do this as well. 920. Okay, now we're back to like 80%. Okay, that's great. Now, if you hover over here, you can see you're collecting 225. Look at the bottom left of the screen in the T color. Now let's look at the margin. Now, I was going to show you the break even now. If you hover over here, your break even has come down to 212, because 215 minus the 225 credit will give you a break even. This is where you sold it. This is your short strike at 215, and this is your max profit on top. The stock, if it goes to zero, obviously you will lose a lot of money. Okay. Now confirm and send this. Let's see the margin requirements. Now this thing is charging you $21,000. It's charging me $21,000, right? Now, how did it get that number? So let me just do the calculation here. If you were to buy this stock outright, it would have cost you 215 times 100, and that's 21,500, and that's exactly what it's charging you minus your credit. So minus 225, 21,275 is the number here that it's charging you. So it will cost you same as your buying power that you would have put down to like buy the stock, but this way you can get it at your price, not at the market price that it's giving you. The market price right now is 230. If you were to buy it at the market, it will cost you 230 times 100. That's 23,000, right? Now, let's say once you've taken delivery of the stock, you got assigned, you like the price. Now your break even is 260. Sorry, not 268. Your break even is 212. Your cost basis is $212. Now, what would you do when you acquire the stock with a cost basis of $212? And let's say now you are into this expiration cycle, which is 66 days out. Now, remember, you bought it at 212, which is a really low price. So you will sell. Again, my go-to is between 21 and 16 and 17. You can sell a little bit higher and collect more money. This is the covered call strategy, the other side of the wheel strategy that we call it. Okay. Let me take you through it. So then, now this is a different example. If you owned 100 shares of Microsoft at 300, you would sell a covered call at 310 for $3 and collect $300 instantly. Now, you always need to look at liquid tickers and then roll calls if needed. What do I mean by that? So let's get back to our Apple example. Let's say we got assigned at 212 and you are happy to let this stock go away at 250. That's where you will sell the call strike. If you are not happy to let it go away at 250, you want a little bit more upside, you can wait or sell it at 260, which will give you $1 compared to $2.50. You can let it go at 255, it will give you 170 or 166, right? If you don't like any of these, you can go into the next cycle and see how the open interest is on the call side. Look at the open interest. There is still a lot of open interest, so you can sell it here. You can buy time to keep going further out. That's another way of like letting the stock go away at your price. Because and let's say you want the December cycle now. By the end of the year, you're like, okay, I'm gonna let it go away, but at my price, and that price will be 265. So you can sell it here. There's plenty of liquidity in this underlying ticker, so therefore you don't need to worry about that. Why am I buying? I need to sell. So let's say I decided to like sell it at 260. I got it at 212. I will sell it at 260. Okay. This is what I will do. I will sell a single, and I'm selling it at $3.50. So you can see the bid and the ask here. Very, very tight markets, and the markets are closed right now, so it's probably a little wider. So if you analyze this trade, obviously it's not going to show you anything, but because the stock is not acquired yet. So that's what I would do if I already have a position in my account that I'm willing to let go at a certain point. The next thing I would look at as a cover call is if the market goes above and it reaches my strike, I will let the stock go because that's what I initially planned to do. And that's what I'm doing right now because I'm selling it at that strike. If I don't want to do it, I can close this option out in this cycle, and then I can open a new one in the next expiration cycle. That's one way of rolling the call and not letting your stock get away from you. You will still be positive in the strategy because your stock has gone up from 212 to 260 to come and get you. Okay, that's a big $40 price move here. Now this will cost you $21,000 to $22,000 to initiate on the put side, and then on the call side you don't need to put any margin out. Only the commission that you pay, the 65 cents for the option that you would pay to sell and then buy back another 65 cents. That's the only money you need. But if you have a very small account, like $5,000 to $10,000, the upcoming strategy is for you. So take a look. So if you really now the third one I was going to discuss today was like the credit spread strategy. Let me know if you want a copy of this document. I can put it in the show notes. But Here's what I would do if I have a really small account, okay? And I'm still selling here. Now we're talking about put spreads, not just naked puts. So I would still sell it at 20 delta and then actually maybe go a little higher on 27 delta. And then I'll sell a vertical and I will buy it back at 215 or 210. Buy this thing back at 210. Okay. Now you're still collecting $1.75 and look at your break even point. So let's analyze this trade. Take this out. And you can still get assigned in a credit spread as well, meaning your short call gets assigned and then your short put and your long puts your short put gets assigned and then your long puts get assigned, so the whole spread is now assigned to you. What you would do in that situation is the short put will deliver you the shares, the long put will be in the money for you, will be making a positive impact in your account. So what you would do is just sell it in the market, back in the market. The short put side of this spread will give you the shares that you needed always. And then the long put side of this will be in money for you because the market has dropped. And because it's dropped and you're positive, you can quickly close that option out by just selling it back into the market at a higher price than what you paid for it. Okay, what was I doing here? I forgot. So I'm going to break even 920 and I'm changing the 920. Okay, similar but slightly less probability of profit, which is expected. That's how it's supposed to work. And then if you hover over this thing, you can see that you are making $175 total. Now your max loss is 825, so it's really capped. Okay, when it's capped, and you see the amount of margin that you have to put down is you only put down the max loss of the strategy. So the width of the strikes, which is $10 minus your credit, which is 175, leaves you with $825, which is what you will put down to initiate this trade. Now also remember, because there are two legs in this trade, you are getting charged 65 cents times two. That's my account. Yours could be different. So that gets taken away from your overall credit. It will be the same when you buy this spread back or when you close these options out. I would have to pay another $1.30 to buy these options back. To close the spread out. So this is a strategy to also get assigned for a smaller account. If you don't have $21,000 cash in your account, you can do the same thing for less than $1,000. And here there is a chance to get assigned on the short put and then also a chance to get assigned on the long put. Both of them will work in your favor because you always wanted the delivery of the stock or the underlying asset, and your long put option will be in the money. So you can easily close it out in the market. Now, these are the three beginner-friendly strategies that I've always dealt with, that I've taught students and all that. And if you really want to dive deep into these, like how the risk management works, this was just a brief intro on all these, how the risk management works, how do we roll it, when do we roll it, how do we manage the risk in these strategies, and what do we do when we actually get assigned. I do run a 5-day option trading challenge where I teach my students just that. Go onto this page. I'll put the link in the description. Watch this video. Highly recommended. You will learn about how we conduct these classes every day, and see if you like it. Sign up. There's one coming up in a week, and this is what we discuss and trade and teach in these classes. We do a live trade setup every single day. We do 4 of these. So there's a 5-day challenge. So we do 4 of these. And then credit spreads comes in at day 4. We talk about both bull put and bear call spreads. And we do a lot of other things in this. And then we finally put it all together and then see what action plan you need to take based on your account and your commitment to trading, on how to grow your account and how to learn this thing. So I could have put all of this in a course, but then again, you would have bought that course and then sat on it for like 3 years and you would not have done anything about it. So instead of doing this in a course, that's the whole idea. I can teach you this in 5 days, and then you can either stick with me, ask me more questions about it, or you can go ahead and start your paper trading account if you're brand new, or if you're an intermediate or an advanced trader, you can go out and trade these strategies live in the market based on your account size. So these are, if you like, you can join us and see what this is all about.
There's a money back guarantee. If you don't like anything, you can just email us. There's a return policy here. Just read about it. It's no questions asked. 100% back result, guarantee. If you don't like it, just email us and then we will refund your money 100%, no questions. Okay, thank you very much, and I'll see you in the next video. Thank you. Bye bye.